The market isn't always a thrilling uptrend or a panic sell-off. Most of the time it's quietly sideways. Yet this boring phase hides the footprints of smart money. Watch how volume subtly contracts on reactions, spreads tighten, and demand quietly accumulates before the next explosive move. Those who can read these subtle signs don't guess, they act while others wait, riding the whale's stealthy build-up before the pump. You must understand one thing from the outset: a sideways market is not a lack of action. It is the heartbeat of intelligent accumulation. Too many traders dismiss periods of range, bound price movement as boring, as if the market had gone to sleep. Nothing could be further from the truth. The most critical activity, the activity that determines who wins and who loses, is happening quietly beneath the surface. The public only sees the horizontal lines, the professional sees the invisible currents of supply and demand. During these periods, the big operators, whales, institutions, and smart money are at work. They do not rush. They do not reveal themselves with grand moves that would attract amateur attention. Instead, they quietly accumulate their positions, absorbing supply from those who are anxious, impatient, or uninformed. The sideways market is their canvas. Every small pullback is a test of selling pressure, every minor rally a probe of demand. The spreads tighten, the volume contracts on reactions, and subtle clues appear for those trained to read them. To the untrained eye, price bouncing between support and resistance is meaningless. To the student of Wyckoff, it is a symphony of intent. Every bar, every volume tick tells a story. Why does price refuse to fall below a certain level despite repeated attempts? Why does it struggle to rise even when bullish sentiment seems strong? These are the questions that separate the herd from the informed trader. Whales do not push price carelessly. They seek to accumulate without alerting the public, to gather shares at a favorable cost, and to do so in a way that leaves the market looking boring until the final act. It is during these sideways periods that your discipline is tested. Many traders grow restless, chasing false signals, taking trades out of boredom, or assuming that no movement equals no opportunity. The Wyckoff student knows better. The opportunity is hidden, but it is real. By watching how price behaves at the edges of the range, how volume expands on small advances and contracts on reactions, and how the market tests support and resistance, you can position yourself alongside the operators rather than against them. Patience, observation, and a methodical study of the tape are your tools here, not impulsive speculation. Remember, a sideways market is not a market without direction, it is a market with purpose. The direction is simply concealed until the smart money has finished accumulating. Those who understand this will enter positions before the public even realizes what is happening. They trade with intent, guided by observation rather than guesswork. The boring market is the precursor to explosive movement, the silent prelude to the crescendo of price action. To dismiss it is to abandon the greatest edge the market offers, the chance to follow the footprints of those who move it. In short, the sideways market is your classroom, and the operators are your teachers. Learn their language, recognize their methods, and you will find opportunity not in the noise of frantic moves, but in the calm of patient accumulation. This is where real profits are born quietly, steadily, and with certainty. Let me impress upon you an essential truth in the markets. Price alone is deceptive. It tells only the final story. The real language of the market is volume. Volume is the voice of professional operators, the clear expression of demand and supply at work behind the scenes. Those who ignore it, or treat it as an afterthought, are doomed to follow the herd rather than anticipate its direction. Consider a sideways, boring market. Price may barely move, bouncing between support and resistance, offering no apparent edge. The public grows restless, labeling it dull, but the astute observer knows better. It is in these quiet periods that volume reveals the activity of smart money. Every increase in volume on an advance tells a story demand is being met, buyers are willing to step in, and supply is being absorbed. Conversely, when volume contracts on a reaction, it signals that selling pressure is weakening, that the market is holding firm, and that the operators are in control. The patterns are subtle. You will not see dramatic spikes or obvious explosions of activity at every turn. The professionals act with precision, accumulating positions gradually to avoid detection. Look closely. A narrow spread accompanied by unusually low volume on a pullback indicates that sellers are failing to assert themselves. A slight increase in volume as price rises, even without a strong price move, suggests that demand is quietly expanding. These nuances are the footprints of the operators, and reading them accurately is the difference between success and failure. Volume is your earliest warning system. It precedes price movement, it announces intent before it manifests in the charts. While the public reacts to visible trends, the professional acts on volume signals, positioning themselves ahead of the move. Observe how, in accumulation phases, volume often contracts on small declines and expands modestly on advances. This is deliberate. The smart money is testing the market, gathering shares without alerting the masses, and the informed trader who understands these signs can enter with confidence while others hesitate. Many traders become frustrated when price meanders sideways. They chase indicators or guess at breakouts. The Wyckoff student knows that impatience is costly. Instead, study the volume. Ask yourself, is selling dying out? Is demand being met quietly? Are the operators accumulating while the public sleeps? The answers are always present, embedded in the volume, if you know where and how to look. Remember, volume is never meaningless. It is the pulse of the market, the prelude to every significant move. Learn to read it, and you will know the difference between random fluctuations and deliberate, controlled action. Price will follow volume, not the other way around. By the time the public recognizes the trend, you will already be aligned with it. Ignore this law, and you are merely guessing. Embrace it, and you are trading with certainty. In essence, volume speaks first. Listen carefully, study attentively, and let it guide your decisions. It is the voice of those who move the market, and it is your most reliable teacher. To trade successfully, one must understand a fundamental principle. Price is never random. Every movement, every bar, every fluctuation is the visible result of forces at work behind the scenes. Price alone may appear silent, but to the trained eye, it speaks volumes about the intentions of professional operators. In sideways or boring markets, this principle is most evident and most important. Consider a market moving within a range. The public may dismiss it as indecisive or dull, yet this is precisely where the operators are most deliberate. Price action is their language, their method of communicating supply and demand without alerting the masses. Observe the reactions within the range. How often does price test a support or resistance level, only to retreat softly rather than break dramatically? These are tests, deliberate and calculated. On minor declines, notice the spreads and the volume. Narrow bars on low volume indicate weak selling, a failure of supply to dominate. Conversely, modest advances accompanied by expanding volume signal increasing demand. These subtle movements reveal intent far before the breakout occurs. Do not be fooled by the superficial appearance of stagnation. Every reaction within the range is a probe. Operators are testing the waters, gauging the strength of public interest, and quietly accumulating positions. They do not need to push price forcefully. That would draw attention and create unnecessary risk. Instead, the price action is choreographed to appear random or indecisive, while the operators quietly build their base. Understanding this is the key to aligning with them rather than fighting them. Price action also reveals where the market is vulnerable. When reactions grow shallower and rallies gain slight but steady momentum, it is a sign that the balance of supply and demand is tipping. The smart trader notes these small shifts, recognizing that the market is preparing for a more decisive move. By the time the public notices the breakout, the operators have already positioned themselves profitably. If you learn to read these subtleties, narrow spreads on pullbacks, volume diminishing during reactions, small accelerations on advances, you gain insight into intent long before it becomes obvious. This is why indicators alone are insufficient. Indicators lag, they react to price after the fact. Price action, on the other hand, is real-time information, the direct communication of market forces. By studying how price behaves at key levels within the range, you can see who is winning the tug-of-war between supply and demand. Is selling failing to push price lower? Is demand quietly absorbing the supply? Every answer is written in the bars, waiting for the attentive eye. In short, price action reveals intent. It tells you who is in control, where the market is building energy, and where opportunity lies. The Wyckoff student learns to read these signals with patience and discipline, to align with professional operators, and to avoid the impulsive mistakes that plague the uninformed. Price may appear sideways, dull, or uneventful, but for those who know its language, it is a clear map of intent, a map leading directly to profit. In the study of markets, one principle stands above most others: price respects levels established by the balance of supply and demand. These levels, commonly known as support and resistance, are far more than lines drawn on a chart. They are the fingerprints of professional operators, the zones where large interests defend their positions or attempt to accumulate more without revealing their hand. To the Wyckoff student, these levels are not mere reference points, they are a compass, guiding every decision in range-bound or sideways markets. Take the sideways market, the so-called boring market. Price oscillates between a support floor and a resistance ceiling, giving the impression of indecision. Yet nothing is accidental. Every touch of support is a test of selling pressure, every approach to resistance a test of buying power. Operators are quietly observing, gauging the strength and willingness of the public to sell or buy at these levels. When support holds, despite repeated attempts to break it, it signals absorption. Large players are taking shares off the weak hands without moving the market aggressively. Conversely, when resistance holds and rallies fail to expand with sufficient volume, it indicates that supply is defending that level, but it may also be an area where accumulation above the public's sight is possible. Understanding these dynamics is critical. The untrained trader may enter positions randomly or chase price once it breaks a level, often too late. The Wyckoff student does the opposite. Support and resistance are not just guides for stops or targets, they are zones of informed opportunity. When price approaches the lower boundary of the range on diminished effort, with narrowing spreads and declining volume, it is an invitation to consider entering in alignment with demand. When price nears resistance but fails to explode, it is a signal to observe, not guess. Every level tells a story. It is the narrative of professional control written in real time. Moreover, these levels are not static, they evolve. Watch how price behaves at the edges of the range. Is support being tested more frequently but holding? Is resistance weakening with each attempt to push through? These observations allow you to anticipate the next move before the breakout becomes visible to the public. The operator's intentions are embedded in these interactions. By positioning near support with a clear understanding of invalidation points, you align yourself with the professional flow and reduce risk while maximizing potential reward. In sum, support and resistance are the compass and map for the disciplined trader. They guide entry and exit, reveal the intentions of large operators, and clarify the zones where opportunity is greatest. Sideways or range-bound markets are not dull. They are structured classrooms, offering clear lessons for those willing to observe, analyze, and act with patience. Price will always interact with these levels in a purposeful way, To ignore them is to wander blindly. To study them is to trade with foresight, precision, and confidence. Remember, in every sideways movement, support and resistance speak first, and those who listen carefully can navigate the market with certainty while others guess blindly. If there is one quality that separates the successful trader from the chronic speculator, it is not intelligence, speed, or even courage. It is patience. The market does not reward constant activity. It rewards correct alignment. Yet most participants feel compelled to act simply because the market is open. This impulse is the greatest enemy of sound speculation, especially during sideways or so-called boring markets. In a range-bound market, nothing appears to be happening on the surface. Price drifts, reverses, and repeats. The public grows restless. They enter trades without cause, exit without reason, and blame the market for their losses. What they fail to understand is that the market is not designed to entertain them. It is designed to transfer money from the impatient to the prepared. The professional operator thrives in these conditions precisely because he is not in a hurry. Patience is not inactivity, it is selective action. The informed trader waits for the market to reveal its hand. He observes how price behaves at support and resistance, how volume responds to advances and reactions, and whether supply or demand is asserting control. He does not act on hope, boredom, or prediction. He acts only when the evidence aligns. Until then, waiting is not weakness, it is discipline. Sideways markets exist to test this discipline. Operators deliberately keep price confined while they accumulate or distribute. This lack of movement frustrates the public and induces emotional decisions. Traders begin to anticipate breakouts, trade prematurely, or abandon sound judgment. The Wyckoff student understands that nothing of importance happens until the market is ready. His job is not to force trades, but to recognize when conditions are ripe. You must train yourself to be comfortable doing nothing. This is difficult because human nature equates activity with progress. In trading, the opposite is often true. Many losses are not caused by incorrect analysis, but by acting too soon. Patience allows the market to confirm your premise. It gives you clarity, reduces emotional interference, and ensures that when you do act, you act with conviction and precision. When patience governs your decisions, fear diminishes. You are no longer chasing price or reacting to every fluctuation. You know where you are wrong before you enter the trade. You know why you are entering, and you know where the opportunity truly lies. This transforms speculation from gambling into a professional operation. Remember this, the market does not move when the crowd wants it to move. It moves when the operators are ready. Those who wait for confirmation participate in the move. Those who act on impulse provide the liquidity. In every sideways market, fortunes are being prepared, not by constant trading, but by patient observation. In the end, patience is not merely a virtue in trading, it is a requirement. Without it, no method will save you. With it, even the quietest, most uneventful market becomes a field of opportunity. The trader who learns to wait will always arrive before the crowd. You must clearly understand this principle if you wish to speculate with intelligence. No significant advance occurs without prior preparation. The dramatic moves that captivate the public, the sudden rallies, the powerful breakouts, the so-called pumps, are never spontaneous. They are the final expression of work that has already been completed quietly, methodically, and often invisibly during the preceding range-bound period. The advance is the effect, the build is the cause. In the sideways market, professional operators are engaged in preparation. They are accumulating inventory at prices that allow for profit while carefully avoiding attention. This process cannot be rushed. Large interests cannot enter their positions in a single moment without forcing price sharply higher and alerting the public. Instead, they must absorb supply patiently, allowing price to oscillate within a defined range while weaker holders are discouraged and eliminated. This is why the boring market exists. It serves a purpose. It exhausts the impatient, frustrates the undisciplined, and transfers ownership from emotional hands to informed ones. During this phase, the public sees stagnation. The Wyckoff student sees structure. He watches how price responds to repeated tests of support, how volume behaves on advances and reactions, and whether selling pressure is diminishing. These are not random movements, they are rehearsals for the coming advance. When accumulation is nearing completion, the character of the market subtly changes. Reactions become shorter, pullbacks lack force. Demand begins to assert itself with slightly improved results. Resistance is tested more frequently, yet supply fails to drive price lower. These are not coincidences, they are confirmations that the groundwork has been laid. The market is being prepared for movement, not because of news or excitement, but because the balance of supply and demand has shifted. The public does not recognize this phase. They require obvious movement to believe. By the time the advance becomes visible and enthusiasm appears, the opportunity has largely passed. The professional trader, however, acts during the build. He enters when risk is smallest, near support, within the range with clear points of invalidation. He does not chase strength, he anticipates it based on evidence. Understand this: the pump is not the opportunity, it is the announcement. The opportunity existed long before, during the quiet accumulation that preceded it. Those who buy the breakout often provide liquidity for those who accumulated earlier. This is not manipulation, it is market logic. The strong buy from the weak, and the move follows naturally. The trader who wishes to profit consistently must shift his focus away from excitement and toward preparation. Learn to recognize the build, respect the range, and study the signs of accumulation. When you do, the so-called pump will no longer surprise you, it will simply confirm what you already knew. The market rewards those who understand cause and effect, and nowhere is that law more evident than in the relationship between the build and the advance that inevitably follows. In closing, let me leave you with this essential understanding: the market is not chaotic, nor is it designed to reward excitement or constant activity. It is a structured mechanism governed by the law of supply and demand, and its most important work is done quietly, long before the public becomes aware of it. The sideways boring market is not an absence of opportunity, it is the foundation upon which every significant move is built. Within these ranges, volume reveals intent, price action exposes control, and support and resistance act as the boundaries of professional operation. Patience is the discipline that allows you to see these elements clearly, while impulse blinds you to them. Those who wait for confirmation trade with understanding. Those who chase movement trade with emotion. The advance that follows is never accidental. It is the natural result of preparation completed during the period most traders ignored. If you learn to study these quiet phases with objectivity and restraint, you will no longer fear inactivity or mistake boredom for danger. You will recognize that opportunity favors the observant, not the impatient. The market always signals its intentions in advance, but only to those willing to listen. Align yourself with cause, and the effect will take care of itself. This is not speculation by chance, it is speculation by design.